The national debt will burden the economy. What is meant by national debt is the net accumulation of the government annual budget deficit. The national debt level of the Malaysia is a measure of how much the government owes its creditor. So why is national debt burden to the economy? National debt will lower national saving and income. Large sustained federal deficit cause decreased investment and higher interest rate. With the government borrowing more, a higher percentage of the saving available for investment will go towards government security. This in turn will decrease the amount invested in private ventures such as factories and computers, making the workforce less productive. Next is higher interest payment, leading to large tax hikes and spending cuts. As interest rates return to more typically level from historically low level and the debt boom, federal interest payment will increase rapidly. As interest take up more of the budget, we will have less available to spend on the program. If the government wants to maintain the same level of benefit and services without turning a large deficit, more revenue will be required. Third, decreased ability to respond to the problems. Government often borrow to address unexpected events like war, financial crisis, and natural disaster. This is relatively easy to do when the federal debt is small. However, with a large growing federal debt, government has fewer options available. Lastly is greater risk of a fiscal crisis. If the debt continues to climb, at some point investors will lose confidence in the government's ability to pay back borrowed funds. Investors will demand higher interest rate on the debt, and at some point rate could rise sharply and suddenly, creating broader economic consequences.
Definition for internet debts in terms of public finance is basically internet debts or domestic debt is the components of the total government debt in a particular country that is owed to a lenders within the country itself. Actually, the main sources of the funds for internet debts are commercial banks as well as financial institutions. So internet debts is debt owned by a country which is money a government borrow from its citizen. It is a part of the country national debts. There are two examples of internal debt in Malaysia. The most two famous internal debts in Malaysia, which is firstly Malaysia Government Security (MGS) and secondly Malaysia Government Investment Issue (MGII). So let's take a look MGS, which is Malaysia Government Securities. Malaysia Government Security (MGS) are interest-bearing bond issued by the governments through Bank Negara Malaysia (BNM). So Bank Negara Malaysia is a central bank that able to raise a long-term fund from the domestic capital markets to finance or help the government for development expenditure. For example, for national budget as well as Malaysia government subsidy programs. Meanwhile, for the Malaysia Government Investment Issue (MGII) is basically it's same with the MGS but is slightly different, which is MGII is a form of marketable government debt security issued by the governments of Malaysia to raise funds from the domestic capital markets to finance all or most of the government development expenditure. So it is actually same with the MGS with I mentioned just now, but MGII is according to Sharia principle. The most example that I able to give is like Sukuk Prihatin is one of the MGII that Malaysia issue for combat the pandemic of COVID-19 last year. Okay, now we move to the next slide, which is the foreign holdings of Malaysian government bond, which are firstly Malaysian government securities and lastly Malaysia government investment issue (MGII), which is rose by 4.4 billion ringgit to 215 billion ringgit or 25% of the total outstanding in March 2020 last year. So basically this is the highest share since April 2018 by referring to the pie charts. Foreign investor holding of Malaysian government security MGS rose 1.5 billion ringgit to 184.6 billion ringgit, equivalent to 40.8% of the total Malaysian government securities MGS outstanding. Meanwhile, for the Malaysian government investment issues is the Islamic securities issue in compliance with the Sharia requirements and is an alternative debt instrument for the governments. Foreign holding for Malaysian government investment issue MGII stood at 30.7 billion ringgit, where you can refer to the pie charts, equivalent to 8% of the total Malaysian government investment issue MGII outstanding in March 2020. So these data are issued by the UOB Global Economics and the Market Research 2020. Now we move to the bar graph below, where according to the Ministry of Finance or MOF, Malaysian national debt is expected to reach up further to hit 61% of gross domestic product GDP in 2021, up from 60.7% in 2020 and 52.5% in 2019. So the national debt had already expanded to 874.27 billion ringgit, or 60.7% of GDP as at end September 2020 last year. So basically, domestic debt, mainly Malaysia government security MGS, as well as Malaysian government investment issue MGII, made up 96.7% of Malaysia's borrowing in total.
Assalamualaikum. For the next two internal debt will be explained by me, Muhammad Hakimi bin Kamal Azman, which is Malaysia Treasury Bills and Malaysia Islamic Treasury Bills. Malaysia Treasury Bills is a short-term discount securities issued by the Bank Negara Malaysia or Central Bank for working capital requirement. It is issued with original maturities of 3 months, 6 months and 1 year. The function of Malaysia Treasury Bills is to finance government expenditure. So now let's move to the characteristics. First, risk-free. It is the safest form of investment because they are backed by the government. Second, zero compound. No yield, any interest, but issued at a discount. And third, availability. Highly liquid, negotiable instrument available in financial market. So basically, Malaysia Treasury Bills is a security issued by the government. When you buy one, you are essentially lending money to the government. The term security means any medium used for investment such as bills, stocks or bonds. Treasury bills have a face value of a certain amount, which is they are actually worth, but they are sold for less. For example, a bill may be worth RM 10,000, but you would buy it for 9,600, which is there is the discount rate is set as a percentage. For example, the discount rate is 4%. So from the 10,000 with the discount rate of 4%, you will get 400 as a discount. So you buy it just for 9,600. So now let's move to the process. So the first process is a treasury bill is auctioned and typically bought below face value. The second step is the investors hold the treasury bills until it matures. And the third step will be the investor is paid face value. So next, Malaysia Islamic Treasury Bills. Malaysia Islamic Treasury Bills is a short-term government securities which traded on a yield basis. The maturity of the bills are issued at a discount from their par value. This means there is no interest on treasury bills, since they are traded at discount from the face value and bearing securities based on Islamic principle. It issued to finance the operating expenditure of the Malaysian government or to help finance the national debt. Only banks such as Bank Islam Malaysia Berhad and Bank Muamalat Malaysia Berhad and principal dealer with Islamic bills are allowed to tender for Islamic treasury bills. Both conventional and Islamic banking institutions are allowed to trade Islamic treasury bills in the secondary markets. And it is also traditional liquidity management tool for Islamic banks. So we move to issuer of Malaysia Islamic treasury bills. It is the securities sold by the Malaysian government with initial maturity of less than 1 year. Malaysia Islamic treasury bills are sold at discount through competitive auctions facilitated by Bank Negara Malaysia or Central Bank with original maturities of less than 1 year, such as 3 months, 6 months, and 1 year. So we move to the Act. Malaysia Islamic Treasury bills are issued under the Government Funding Act 1983. In the Act 637 and 275 is to authorize the federal government to raise funds within Malaysia for development expenditure such as health insurance, retirement benefits, and national defense. And it is also to refinance maturing debt. So we proceed with the process of Malaysia Islamic Treasury bills. It involves sale and buyback transaction between central bank and banks. It has element of buy-in. Islamic Treasury bill will traded based on the principle of buy-in. Buy-in refers to the sale of a debt arising from a transaction in the form of a deferred payment sale. The instruments are issued using Islamic principles such as Ba'adin, Ba'ina, and Murabahah, which are deemed acceptable to Sharia requirement. Malaysia Islamic Treasury bills are issued and traded based on a discounted basis. The tenure issues are between 21 days to 1 year only. The zero credit risk is assigned as it is issued by Bank Negara Malaysia. That's all from me. Thank you.
Hello, my name is Amir Ashraf from BA250. So now I'm going to explain what is external debt. So what is external debt? It is a country's debt that was borrowed from foreign lender, including foreign commercial bank, foreign government, or international financial institutions such as the World Bank and IMF. This is the debt undertaken in non-RM currency. It is important to note that the country's debt doesn't confine to the government only. Rather, it is the combination of all residents comprising both public and private sector. So what constitutes the debt? So as far as the external debt is concerned, it is placed within 4 categories, which are loan taken from the World Bank and IMF, private non-guaranteed debt, public debt and public guaranteed debt, and central bank deposit. So, the impact of external debt to our economy. So, one of the impact of the external debt to our economy and financial is an excessive amount of foreign debt will hinder countries' capacity to invest into financial prospect, whether through education, infrastructure, or healthcare, because still small income is spent on repayment of loan. It is a challenge to economic development in the long term. Alright, that's all from me. Thank you so much.
Assalamualaikum Madam Zuraida. I'm Muhammad Ashraf bin Zain Abidin, and I'm going to present about Malaysians and external debt. External debt is a portion of a country's debt that is borrowed from foreign lenders, including commercial banks, governments, or international financial institutions. These loans include interest must usually be paid in the currency in which the loan was made. To earn the needed currency, the borrowing country may sell and export goods to the lending country. One of the most popular of external debt is offshore banking. The offshore term is commonly used in banking and financial sector to describe areas where regulations are different from the home country. Offshore generally located in island nation where entities set up corporation, investment and deposits. Typically, high net worth companies or individuals may move to offshore for more favorable conditions such as tax avoidance, relaxed regulations, or asset protection. Offshore institutions can also be used for illicit purposes. They aren't considered illegal. In December 1999, Offshore Banking Act and also Labuan Offshore Financial Service Authority has exempted uh, offshore bank from Sector 20 of Offshore Banking Act. This provision prohibits offshore bank from dealing or transacting in Malaysian ringgit, save as otherwise provided. Uh, Thus, based on the recommendation, offshore banks with no onshore subsidiary are allowed to extend Malaysian ringgit loans to eligible resident companies categorized under companies registered with the Corporate Debt Restructuring Committee (CDRC). Um, Participation in Malaysian ringgit loans by offshore banks and the resident companies are still subject to prior approval from BNM. There are a few conditions on Malaysian ringgit financing. Firstly, is the source of Ringgit Malaysia fund is derived from the sales of foreign currency to domestic banks or from borrowing in Ringgit Malaysia from domestic banks. And secondly, offshore banks are not allowed to enter into any hedging arrangement for sourcing the Ringgit Malaysia funding through the sales of foreign currency. Next, Ringgit Malaysia borrowing by offshore banks should not exceed the total Malaysian ringgit loans extended to the resident companies. Fourthly, offshore banks are not allowed to sell down the Ringgit Malaysia loan to the offshore parties. The banks are also prohibited from participating in the trading of Ringgit Malaysia instrument. And lastly, all transactions must be booked in Labuan. That's all from me. Thank you.